Broadcast is now starting. All attendees are in listen-only mode.
Hey there, everybody. This is AJ with Trading Trainer. Listen, I am seeing people still entering into this webinar, and this webinar is going to be a very wild learning experience. So I want to let as many people get in. So I'm going to go about 2.5 more minutes to let people get in. But in the meantime, please get yourself a writing utensil and something to write on, because I think you want to take some notes. Okay? And I'll be back in about 2 minutes, and then we'll get started. I just want to make sure people are available to get going with this. Thank you. All right, all right, all right. We're going to go ahead and get started now. Thank you, everybody, for joining me this evening. This is AJ Brown speaking, and we are here for my presentation on how to trade the current market drop with minimal risk. Now, the scoop is I want this to be interactive, and I want you to take lots of notes. I put a lot of learning material that I usually only share with paid subscribers into this presentation. And so I really want you to get the most out of it. So, couple ways for you to be interactive. First of all, throughout the presentation, I may ask you questions, and I want you to be able to raise your virtual hand. I've actually got a administrative panel here where I can see all of your names of all the people who have joined us this evening. And so I want you to be able to raise your hand if it makes sense. So take a look at your webinar control panel up in the upper right-hand corner of your screen. First, you should find an orange button with a white arrow on it. If you click that button, it's going to squeeze that webinar control panel off your screen and get it out of your way. And I recommend you do that because it takes up valuable screen real estate in like the business portion of our trading charts, the right hand edge, that's where the current data is. So squeeze that off. You could always squeeze it back by pressing the same button again. So please know where that orange button with the white arrow on it is. Now below that button, you'll also find a few other buttons. One of the other buttons, if you click on it, will take my screen and it will fill up your screen. Because the last thing you want to be doing, especially if you're watching this on a tablet or a mobile device, mobile phone, is watch this in a tiny little square. But even on a laptop or a desktop, watching a little tiny square, at least my eyes can't do that anymore. So what you might want to do is click that button and make it take up your full screen. That way you won't have to squint. And then finally, there's a hand raising button at the bottom of that vertical array of buttons with the orange with the white on the top. Let me see that you know where that hand raising button is. Please raise your hands now. Excellent. Excellent. I'm seeing all these hands go up. You might notice that that button changes shape on you, telling you that your hand is up. And then go ahead and put your hand back down. Absolutely excellent. All right, so we'll be interactive that way. The other way that we'll be interactive is at the end of this presentation, I do want to make it possible for you to get any of your questions answered that are burning in the back of your mind. And I'm going to be here and I'll stay on the line for you and answer your questions. So when my presentation is complete, I will open up the question and answer area so that you can then type those questions into me. In the meantime, if a question is already burning in your head or one comes up during this presentation, please write it down in your notes so you don't forget. Sound good? How many with the show of hands are ready to begin? Okay, good. So I want to talk about trading the current market drop with minimal risk. Now, the first thing I have to do, of course, is make sure you know that information charts or examples contained in this presentation are definitely for illustration and educational purposes only. They should not be considered advice or an endorsement to purchase or sell any securities or financial instruments. We do not and cannot give any kind of financial advice. No employee or person associated with us here at Trading Trainer are registered or authorized to give you financial advice. We do not trade on anyone's behalf, and we do not recommend or receive any payments for any broker. So please don't ask me which is the best broker. In my humble opinion anyway, they're all basically the same. You're going to pay extra if you want more support. You're going to pay less in the form of commissions if you want to have no support. It's up to you to decide which is the broker that's right for you. Some of them have better tools than others, but a lot of the times the tools can be found on the web. Brokers are a dime a dozen. They're merging and they're consolidating, and then often they're splitting off. Right now they're in a big merger phase. And just know that with especially the rules that came after the 2008 shakedown, that they must allow you with no cost the ability to move your account to another broker. And so it's very easy to change brokers on the fly. So if you don't like one, you're not stuck to them. The only thing that keeps people stuck to their broker is, of course, themselves. Now, here are some facts. This is a facts of what's going on right this minute. By the way, I do have a list of symbols that I'll be giving you towards the end of the presentation that'll go along with the trading strategy I'm going to be sharing with you this evening that are working right now that you may want to take and pursue for yourself. So please stay tuned for that list of symbols, and I'm also going to give you access to both my store of white papers that are ever more valid now than they ever have been, as well as if you want to get a session with me over the next couple of weeks. I would love to spend some time with anybody who's actually interested in it. So here we go. Facts. What's happening in the world right now sucks. And I'm talking about what's on a humanitarian basis. Let's just get that out of the way. The toll on life, the toll on people's psyche just absolutely sucks. I'm not going to downplay that in any way. It's just not good. However, what is happening in the markets, if played right, and I'll show you some positions I've got that are setting me up for the year. They've already surpassed gains for me to make 2018 look like a boring trading year. What is happening in the markets, if played right, can set you up for months, if not years to come. And also, a lot of us are being forced to take time off. I know that me and my newlywed wife, we are coming in zero physical contact with anyone out there right now. We're staying far away from everyone. We're still going out every day. We make it a point to go on a bicycle ride every day, but we don't get near anyone. However, I think, and this is just my personal opinion, this whole thing that they're talking about, the talking heads, I call them the talking heads, are talking about called social distancing. I think that they got the name wrong. I think they should be calling it physical distancing. We should all be practicing physical distancing so we don't get each other sick. However, social distancing, you've got FaceTime, you've got Skype. I've been talking to people I haven't talked to in literally months and years, checking in with them, and it's been wonderful. So social distancing doesn't have to happen if we've got our technology in place. It's just physical distancing. A lot of us have a lot of time right now and we don't know what to do. You can either spend the time worrying about what the heck is going on in the world, worrying about perhaps the situation you're in with finances. Maybe you are looking at your retirement account that is in a buy and hold strategy and you're now angry. Maybe you had a job and now you can't go to it. And so the money's not going to be flowing in, but yet the bills are still coming, even with whatever proposed relief they're planning to give us. It's never enough. Still, you've got that time off, and you can either use your time to be anxious about all of these things that you cannot change, or we can use that time. I'm going to show you the strategy I've been using, where even though everything that's happening in the world right now sucks, financially, I'm very, very happy, and I want you to be too. Okay. Couple of words to live by. Please write these down. Whenever you adjust positions, you want to adjust positions in times of peace, not in times of war. How many of you, with a show of hands, have ever heard that before? We adjust our positions in times of peace, not good. Not in times of war. Quite a few of you are raising your hand. How many of you, with a show of hands, have not heard that before? Let me take a moment, because there's a lot of hands going up, to explain what that means. The market has been downturning for the last 3 weeks. If you had prepared your positions in advance with hedges, and those hedges are profiting like no other, you're in a good shape. However, if you're trying to chase this market drop right now, this market drop will turn unexpectedly, and at this point, it is what we call a time of war. The positions are already well on their way to their fruition, and most of the investors, the big money we call them, have already made their money, and there are signs that they're taking profits. That means if you have this fear of missing out and you think you're going to jump in a downtrending trade, you can really wind up hurting yourself more than gaining. And that's what the big money is hoping to do, right? You know, they talk about, the talking heads, about all these dollars that have left the market. They haven't left the market. The market is about transmitting money from one person to another. If there's a person who has lost, if the Dow has gone down, which is just a representative of the overall market cap, there is somebody else who has benefited. So the idea is to get folks to get caught up in a certain frenzy and wind up getting them to cash out. I hope that makes sense. Money is not created or destroyed in the market. It only changes hands. But you must remember that we adjust our positions in times of peace. What does that mean? When the market reverses, that's going to be a phenomenal time to buy things at bargain prices. If you are trying to jump in and catch on this train of shorting the market at this point, you're trying to make an adjustment in a time of war. And it's going to bite you in the butt. So keep this in mind because we use this in our strategy every day, but I want you to write this down. I'm going to leave it up one more time. Words to live by. We adjust our positions in times of peace. In other words, we add additional trades, we do whatever we do, put hedges in place when we don't need them, because if the position has already started to go against us, it's too late. You're only going to add insult to injury. The best adjustment you can do at that point in a time of war is to take your losses and take the position off the table. How many with the show of hands are following? Excellent. This is one of the number one beginner mistakes that can empty your portfolio, is that you try to chase a trade after it's already started to go against you. Fear of missing out can be a real son of a Okay. Also, it's important to remember the premise of successful trading. First and foremost, we have to be very good at recognizing patterns. And these can be patterns in price, which is typically what people think about when they think about trading the markets. But there's also patterns we can utilize that are patterns in panic and fear versus confidence. And there's also patterns in time curves. In fact, before I go on to the second premise of successful trading, one of the reasons why I trade options, and I trade options the way that I do, is because I can profit not only if the underlying symbol is going up, sideways, or down, in fact, especially down, but I can also profit on if investors have panic and fear and uncertainty like they do right now, or if they're confident. That's called trading implied volatility rushes and crushes. And options, because of their nature of being a wasting asset, I can trade them on one of the most reliable patterns, and that's time passing by. And that's one of my favorite ways. It's one of the easiest ways, and it's one of the most risk-free ways. So keep that in mind. With a stock, a commodity, if you're trading the Forex market, you can only trade if the pattern goes up or if the pattern goes down. There's only two ways you can profit on those patterns. If you're trading derivatives like options and futures, there's 27 different ways to profit on market changes, on different patterns. 27 versus 2. I'll take the 27 any day. Second, we use the tools that we have to profit from the patterns we recognize. Now, why do I bring this up? Because I've talked to so many people in just the last 10 days who are reversing these two steps. They have some tool, whether it be doing vertical spreads or doing butterfly patterns or calendars, whatever it might be, whether it's trading stocks, that they have a certain set of tools and a certain process that they follow, and they're trying to do that same exact thing, even though every single pattern except for time curves has changed. It's like if you hired a handy person to come in, and that handy person has been going to all the track homes in the recently built neighborhood, and all that handy person needs is his wrench and his screwdriver, and then he comes into your remodeled turn of the century home and doesn't realize that he needs a hammer, and he goes at whatever job you give him with a screwdriver and a wrench, and he just F's things up, right? Well, the traders that keep calling me, they're like, I must have misread the candle patterns or some kind of crap like that, but I'm just not making money right now. What? Why don't you take a moment and take inventory of the pattern you're in, and then we'll talk about what tools to use to profit, because you're still trying to use the tools that were working 4 weeks ago when the market was barely trending higher, mostly sideways channeling, and it was at the top of its game, not after the last 3 weeks of losses. So write this down, recognize patterns, then use the tools that you have to profit from those patterns you recognize. And the other thing to take away is perhaps patterns and price are not the most reliable things to trade right now. Perhaps we might be wanting to trade something more reliable, and that's what I've been trading over the last 3 weeks. Let's talk about timing of a position. So how many of you with a show of hands have ever been to any of my premium selling presentations before? Oh, good. Let me ask the other question. How many of you with a show of hands have not? Okay, a couple of you as well. It looks like 50-50. When we have been giving presentations in the past, we've been talking about, well, what do you do, and this is a ticker called BBD, what do you do when you want to sell premium on a sideways channeling stock? Well, you could buy an underlying symbol, or you can buy a call option trading at parity, and then you put in place a bailout strategy. Then once it hits a top, you sell your near-term call option. That puts an exercise price. That's what this red line explains. And at the same time, you protect your position with a put option that's 3 to 6 months out. And then that call option expires worthless. We've just made some money on the time passing by, and you sell back that protective put and you start all over again. Or if you're coming from the top side, you can short an underlying symbol, or even better, buy a back month deep in the money, far out in time put option that's trading at parity, put your bailout in place, sell your near-term put option, protect it with a protective call. That put option expires worthless. You collect your premium and you sell back that protective call, and you repeat and rinse. That's what our whole thing is. But what the heck do you do? And I'm going to bring over my Thinkorswim and just overlay it right now. This is that same ticker today. What the heck do you do when that ticker is now trading, instead of in its channel? Over the last weeks, it has dipped down to just a fraction. And we're going to talk about that, because it turns out this symbol has already had a 400% gain for me. What? You went from selling premium to getting a 400% gain? Let's keep going. First of all, I think now's the point. How many of you at the show of hands? I've got 3 slides that give you some thoughts about who I am. How many with the show of hands don't know who I am? Okay, let me put your hands down. How many with the show of hands do know who I am? All right, I'm not going to spend much time on these. I founded a company called Trading Trainer. I founded that company in 2002. I teach full-time traders, and I also teach premium selling to folks. That seems to be actually what's getting me my claim to fame in the last 10 years. I still have quite a few full-time traders who we teach all sorts of option stuff to, but my claim to fame, I guess, is that I teach people how to trade premium, sell premium. You might have seen my home study course. You might even own my home study course. And my real claim to fame is the same premium selling strategy I teach inner city kids. I have a foundation, and I'm very proud of this foundation. It's why I teach any of this at all. It's because I like to teach these inner city kids how to do the same thing I'm teaching you right now. So these inner city kids tend to come to me even though the school system has put them through their paces and they're set to graduate high school. Most of them really only have a 4th grade education, something that you would have when you're 10 years old. And many of them don't have access to computers, let alone trading platforms. So we have to do what we can. And if somebody who has a 4th grade education, who has very little access to the markets, can grasp this, then I know all of you can as well. All right. So I'm going to start off with the premium selling component because I know that some of you might want a refresher, and I want you to take notes about this. This is what premium selling is all about. And then we're going to talk about when the market takes a dump and also when the market rebounds, because the positions I'm going to give you at the end of this presentation are set to profit literally in the next couple of days. Take a look at this picture. I want to burn this picture into your brains really quick. You'll notice that in the legend down here it says range high, range low. Range high in the first cycle here, number 1, range high starts, looks like somewhere around maybe 14%. Range low starts below the 0. Let me get my crayon out. Range low starts below this 0 line. But then by cycle 2, and then 3, 4, this is a scenario where range low still winds up ending with a nice profit. In fact, as you get more cycles, these could be weeks if you're using weekly options, they can be months if you're using monthly options. As you get farther along, whether you get knocked out to range low or whether you get knocked out to range high, this graph is showing you, and this is an actual trade, that it doesn't matter whether you have a losing trade or a winning trade, because it's the time that we're trading here. It's the time we're profiting on. It doesn't matter what the market's doing around you. As time passes by, these options extrinsic value is going to pay off for you. And so people are always asking me, what's my win-loss ratio? It's insignificant because even when I lose, I wind up with as much profit as when I win. Let's come back to this chart, but I want you to have this chart in mind because so many of you are so used to directional trading. If all you do is watch your 401k or your IRA, you're just thinking about the fact that the market is trending down right now in a very fast pace. We call it the bear jumping out the window versus the bull climbing up the stairs. In fact, all the gains that were gained in just the last 4 years are all gone. But if you're thinking directionally, you're not thinking the best way to maximize your profit. Okay, let's keep going. So I always play this game because one of the things I like to do is set up trades that when the market's going normal will pay me a return. I call it income. So which would you take? $50,000 right now or a penny that doubles every month? Now, I know you've probably seen this comparison, but just jot it down in your mind or on your piece of paper. Which one would you take if I gave you one? Do you want the $50,000 cash or do you want the penny? If you took the penny, after a week goes by, you're probably freaking out a little bit because you could have had $50,000. Already about a fourth of the month has passed by and you just got 64 cents. Now about a third of the month has gone by, still nowhere near that $50,000. That sucks because at a minimum we'll probably be quarantining ourselves for the next month. And if 10 days goes by and this is all you've made, you're probably going to be pretty frustrated. However, keep going. Now we're about halfway through the month, still nowhere near that $50,000 you could have had up front. Now we're about 2/3 of the way through the month. We're at $5,242.88. I'm starting to sweat bullets here. Should I have taken the $50,000? All right, here we are. We're about 3/4 of the way. We're at day 24. and we finally surpassed that $50,000. Look at what happens as we get to the end of the month. Now, this happened right at the end week. We had to wait all this time, allowing things to accrue exponentially. And if we did, now it really looks good. $21,474,836.48. It's called compound interest. And that's really what I focus on a day-to-day basis. But I have to hedge my positions. If I hedge my positions, and I'll be showing you how to do that in a couple minutes, then the possibilities for having these gains accrue exponentially when things go out the window, they just add the frosting to the cake. A lot of frosting. Frosting with fondant. Let's keep going. So let's reverse engineer this, because there's no way you're going to double a penny every day. I mean, there's some people out there who will try to get you to buy, programs that'll tell you that they're going to double your trading income every day. But in reality, even with the downturn, if you're long some put options, you're not doubling your money every day. Well, it depends on the put options, but this only happens once in a lifetime, right? So instead, let's say if we're doubling our money every year, let's reverse engineer that so that we have some clear intentions, some clear goals. And that is, if you earn 6% on your money every month, 6%, it turns out that, not counting what's happening right now, the traders that work with us here at Trading Trainer are earning in the double digits, 10, 11, 12, 15% every month. But we focus on 6%. You've heard of, let's aim for the moon and maybe we'll hit the stars. So we aim for 6%. If you aim for 6%, your portfolio is going to double every year. That's how compound, and that's not continuously compounded. That's compounded simple interest 12 times on monthly. If you're going to do weeklies, that's going to be 52 compounds. So depends on how active you want to be. I actually like to do the monthlies myself, but that's because I'm a little bit on the lazy side. So you have $1,000. That means in 12 months you'd have $2,000. In 2 years you'd have $4,050. 5 years you'd have close to $33,000. And in 10 years you'd be a bona fide millionaire. Not bad, right? But here's the part I like. Say you have a $100,000 portfolio. A lot of you might have that. If you put that through this strategy, that means that $100,000 portfolio, if that's what you were spending your time on, working with that $100,000 portfolio right now, that means we'd be focusing on generating $101,219.65 per year. And again, that's if you're only getting 6%. You want more statistics on some of our Trading Trainer clients? Those Trading Trainer clients that we're following very closely, because they're earning 11, 12, 15% gains every month, they're not doubling their money every year, they're doubling their money every 5 to 6 months. But just think this, right now, if things were working here in the States, the average white-collar job, salaried positions, salaried means you don't get paid by the hour. So that means we're talking about somebody who works 60 hours per week, 50 to 60 hours per week. The mean income is $87,000. With a $100,000 portfolio working with our strategy where you hardly put in that much time, you just come in end of day and you allow one of the most reliable patterns to allow you to profit even when the market goes to hell in a handbasket like it has. Instead of profiting on the directional component, we're profiting on time passing by. That $100,000 portfolio is going to pay you more than one of the highest incomes in the US. And you're not going to have to work 50 to 60 hours. So let's answer this question. In fact, I can put this up for you. Let's go ahead and answer it for real. Please come back and man your mouses, because I want to know, what minimum returns must you make monthly on your portfolio? Let's see who's been paying attention to more than double your money annually. Go ahead and answer now. Just click on the screen. About 44% of you have answered. Let's see if we can wake everybody up. If you haven't answered yet, please grab your mouse, grab your pointer, pick one of these on the screen, click submit. I'm going to give you 3. I'm going to give you 2. And I'm going to give you 1. See who's paying attention. 59% of you who are on the line, there's quite a few of you on the line, answered this. And it looks like a lot of people were paying attention, because the answer is 6%. All right, so I guess it's to the point where we say, well, what is it that we're actually investing in? Write this down. We're selling theta decay optimized option premium. What does that mean? We're profiting when time passes by. We're not profiting on directional moves, especially when the directional moves are unexpected. We're profiting on time passing by. Okay? Well, what's this option premium that you're trying to sell? Well, an option has 2 components. When you look up something, I'm going to bring over my Thinkorswim here. When you bring over, for instance, any option price here, like for instance, I'm looking at BBD again, but let's bring up a ticker called PetMed. When I look at one of these option prices, what I notice, or what I know, is that even though the price is about $2.75, that price is actually part in the money and part premium. It's not all just the option price. There's 2 components in every option price. Now, if the option is not in the money, if it's at the money or out of the money, obviously the in the money value is going to be 0, and then the option price will be equal to its premium value. But if it's in the money, there's these 2 components. Some of you are saying, AJ, I know I've heard you speak before, but I don't even know what an option is. So an option is one of these derivatives, typically bought and sold to hedge risk against stocks, indexes, and ETFs, but that's really not what we're doing here. We're selling premium. Now, as I showed you in those diagrams, we focus on 4 simple transactions, right? We like to write covered calls. We like to write covered puts. Basically, we're flipping that covered call upside down. We're profiting to the downside versus to the upside. We also like to write covered calls against leaps. That means we're supercharging the covered call writing. For those of you who have some trading background, you might say that resembles a specific type of bull call diagonal debit spread, and you'd be right. We also have writing covered puts against leaps. That's your bear put diagonal debit spread. We like to do these 4 simple transactions. Why don't we get involved with other transactions? Well, we do if you really need to, but the truth be told, with selling premium, these 4 transactions will reliably give us the income we need to do. Okay, so let's go through an example of PetMed Express. PetMed Express. What is PetMed Express? Has anybody ever heard of that company? Please raise your hand if you have. Let me show you the ticker symbol. Let me show you the chart, I should say. Here's the chart on PetMed Express. Sideways channeler. Been a little volatile recently. This is a place where you can buy your pet its medicines and have them shipped to you. It's actually easier to buy your pet medicines online through PetMed Express than it is to drive to your veterinarian and buy them that way. It's even cheaper. But until now, they've only had so much success. Why? How many with a show of hands think they know why? Raise your hand, why? Why is PetMed Express, despite having cheaper prices, despite having an easier user interface, you just make a couple of clicks online and then the medicines are in your hand the next day. With all those wonderful value propositions, why isn't this company just soaring to the top? It's because people don't like to change. People don't like to change. Even if what you tell them is cheaper and or easier to do, they're still going to do it the old way. However, when it's the difference between coming into contact with somebody who has something that can kill you and learning how to do something that's easier and cheaper, people will take the latter. And then they'll realize that wasn't hard at all. I learned something new. This is cheaper and it's easier. And you have what's called a behavior change. A lot of people don't understand, but this forced scenario is giving companies a huge leg up. People are being forced to change their habits. So one thing you want to look for when you're thinking about companies that are going to recover well is think about these companies that people started to use during the downturn when they weren't allowed to be in contact with people. Those habits aren't going to go back. Now that people have seen the real benefit and they've tried it, companies like PetMed, Amazon, Domino's Delivery, all of those things are causing behavioral changes over the last 3 weeks, sudden behavioral changes. PetMed Express is in a good position right now. I've got a handful of other tickers just like PetMed Express. If we bought PetMed Express at today's end of day price, now what I'm going to feature for you is an example of the worst case scenario. We can do much better of this when people are trading as part of my program. We hold them by the hand and we get them better. But this is what we call a buy right. A buy right is where you do all the transactions at the same time and you do them right now instead of trying to get the best prices. So this is literally if you did this at the end of day prices from today. I took these prices from today. 27.21 is where PetMed closed today. If I bought that and then I sold the April 17th $30 call for $1.65. Now, I want to tell you something else. I've been making a big deal about how options are profiting as time passes by. One of the golden rules of options is that no matter what you try to do, when the option hits its expiration date, its extrinsic value, otherwise known as premium value, will go to zero. By definition, that is how an option works. By definition, an option will be equal to its intrinsic value at expiration because the extrinsic value goes away. However, before that happens, the extrinsic value is influenced by how afraid people are or how confident they are. When people are afraid, they like to buy options to protect themselves. They use them as hedges, and the price of the options go way up. It's actually the definition of implied volatility. When the implied volatility is on the rise, that's because people are afraid. They don't know what's going to happen with price next, and so they start bidding up the price of these derivatives that they use as hedges. Right now, if you take a look at something called the VIX is at an incredible high. That means that when we sell our premium, that's going to, no matter what we say, decay to zero at expiration. Right now, we're getting top dollar. And that doesn't matter. People are just frenzy and feared. And these prices are extremely high no matter what the underlying symbol, even if it's a strong underlying symbol to begin with. So $1.65 is what we would get on selling that call back. So basically we would get for ourselves a discount. We would buy PetMed and then cash in this coupon and get ourselves a discount on the underlying symbol. I also like to call it an instant dividend. For every option contract we sell, we're going to get $165 because option contracts consist of 100 option shares, right? All right. So imagine this scenario. So what happens on April 17th? What if PetMeds is above $30? Well, okay. I bought the thing for $27.21. If it's above $30, I'm going to go ahead and get my $30 back. I get exercised. That gives me $2.79 profit. In addition, I got to keep that $1.65 for selling the call. So the total profit is $4.44. Now, $4.44 on my initial investment, I walk away with 17.4% ROI. Now, remember, all I was trying to go for was 6%. And remember as well, this is one of the worst case scenarios. I can do better than this by simply looking for when PetMed is at a different place on its chart, just timing my trade a little differently. This is if I wanted to just throw caution to the wind and do this trade tonight. Okay, what if PetMed is flat when we get to April 17th? All right, fine. $27.21 is what I paid up front. I made $1.65, so I lowered my cost basis. I've got $1.65 of accrued profit to date. That's a 6.5% ROI so far. And then I've got PetMed to do it again and again and again. And this is actually the ideal state, to just keep collecting premiums. Cool. What if it goes down? Well, first of all, I'm going to show you how we hedge these things to cut off any sort of losses. But I want to also tell you that built into this strategy, there is an inherent buffer. We call it the profit buffer. I bought it for $27.21. I got $1.65 back. That means the profit buffer is $1.65. This thing can drop all the way to $25.56 and I'm still winning but I'm going to show you in a couple minutes how we can even protect it more, just in case the market sells off again in the future. And I'll show you how I'm already ahead 400% in quite a few of these symbols. Okay, here are some gains that we make all the time. This is Micron in 12 trading days. I don't want to take up all the time showing you results, but the stock went up 15% on Activision. The stock went sideways, 14% on Allscripts. The stock took a big dookie. So let's answer this question. In fact, I'm going to throw it up for you to do actually on the screen. Take a moment and stretch. When we sell premium, what does it create? And in this case, you can select as many of these that you think are accurate. Is it an instant dividend? Is it a discount on the security? Is it a profit buffer? Is it an expiring coupon? You might have heard me say 1 or 2 or 3 of those names, whatever. Please answer now. I'm going to give you a couple of seconds and I'm going to take a little sip of water. I'll give you 3, 2, and 1. Guess what? The answer is all of them. How many of you with the show of hands answered all of them? Great. Quite a few of you did. See who's paying attention and who's not. Here's some more gains. 21% on Caesar when it went up, 12% on St. Joe when it went sideways, 17% on Community Health when it went down. So again, what I'm trying to point out here is when you trade option theta decay, time passing by, it doesn't matter if the underlying goes up, down, or sideways. We always profit. Okay, now I'm going to ask you a question before I explain it to you. How can we lower our investment, increase our returns, and even convert a margin trade into a cash trade? By the way, why is it important to convert a margin trade into a cash trade? All the strategies I am showing you today can be used in retirement accounts, tax-free or tax-deferred. In fact, that's the only way I roll. Most retirement accounts, in fact, I haven't found one to date, allow you to do margin trades. So we need to have the power to convert these things into cash trades. Let me go ahead and, now that you've thought about it, let you answer. Now this one only has one answer. Is the answer to sell out in time options? Is the answer to replace the security with an option trading at parity? Is it to give up and buy mutual funds, or is what we're talking about not even possible? Go ahead and answer now. All right, I'm going to give you 3, 2, and 1. So the answer is to replace the security with options trading at parity. Selling out in time options is not so useful. In fact, I'm going to deviate from my presentation for a second. I'm going to pull up a teaching aid that I use for my actual subscribers. And what you can see here is called the option time curve. And it's a very reliable pattern. At the money options decay this way. If we go farther out in time, you're not going to make any more appreciable gains. For the same 30 days, we can make this amount or we can make this amount. So I would rather, please write this down, I would rather sell near-term options twice than sell options that are 2 months out in time. I'd rather collect 2 times this profit than collect this profit and this profit. How many with a show of hands are following? Always sell near-term options. The ideal is 3 to 5 weeks out, no less than 8 trading days. I'll say that again. The ideal is 3 to 5 weeks out, no less than 8 trading days. If you're going out farther than 5 weeks, you are actually doing yourself a disservice. Okay. Let's get rid of my chicken scratch. We're almost done with my presentation. What are options trading at parity? Right? Isn't that what I said? Replace the security with options trading at parity. Option premium is the most when the option is at the money. That's why when we sell our premium, we like to choose at the money, near-term options. We like to err on the side of out of the money, but for the most part, it's at the money. However, if we're looking for a substitute for the underlying symbol, if we go deep enough in the money, the option changes its characteristics. It has very little premium. In fact, we try to target less than 5%, and instead it's almost completely intrinsic value. And you're saying, well, what does that mean? A deep in the money option behaves exactly like the underlying security, dollar for dollar, but it's cheaper. You might also say, okay, I'm going to go deep in the money, but how far out in time should I substitute our options? Right? Because these things expire. Well, let me give you some, again, statistics from actual traders that I pursue and follow. First of all, these traders tend to have positions that last 5 months. Now, this is a flat bell curve. That means we have quite a few traders that have positions that last 7, 8 months, and some that go 2, 3 months. But the biggest, it's a single mode for you statisticians out there is 5 months. But again, quite a few of the positions are lasting 8 months. I had one last September that lasted 9 months. My best ever was one that lasted 14 months in 2011. We need to have that back month option last longer than the number of months that our positions last. You don't want that back month option expiring when you're sitting there collecting income off of it every cycle. That's no bueno. So that's our guideline. To go far enough out in time so that it's not going to interfere with all the income you could get. We buy our back month option far out in time so the substitute option expiration will not interfere with selling many cycles of premium. And we tend to go with leaps because the leaps have more liquidity. Those are long-term equity anticipation securities. In other words, right now we're really focused heavily on the January 2021 options. Very soon, like in a month or so, we're going to actually be more interested in the January 2022 options because the 2021 options will be within that 8 months. Does that make sense? How many at the show of hands are following? Let's stop right there. How many with the show of hands you're getting anything out of this presentation? It's very useful, right? Good, excellent. Let's keep going then. We're about 2/3 of the way through, a little bit longer, actually 3/4. So we're going to find a substitute that trades at parity. Let's bring back PetMed Express. Again, this is the worst case scenario, but if I were to take PetMed Express and instead substitute it with using the PetMed Express January 2021 $10 call, I'd have something that behaves exactly like PetMed Express. It's got 97.5% in the money value and only 2.5% premium value, but it costs just over 50% of the price. It's almost half the price. So let's run through the math on this. So I buy this instead of PetMeds itself. I sell back the near-term at-the-money premium. I get my instant dividend of $165 per option contract sold. What happens if it closes above $30? Well, I get to have $17.65. When it gets exercised or called out, I get to keep $20. You might say, well, why don't I get to keep $30 like last time? Because I have to give the person I bought that call from $10, so I keep the spread, hence the name diagonal debit spread. I keep the difference, $20. That gives me a profit of $2.35. But remember, I've only invested about 50%, a little more than 50% of the original price. I get to keep the $1.65 up front as well. $4 of total profit, or 25% ROI. Again, unheard of on the worst case scenario. It's just showing that the price of options right now is for a seller's market. If you're selling premium, you are going to benefit big time right now. Well, what happens if instead PetMeds goes flat? All right, I pay $17.65 for that back month option. That's not going to expire until January 15th, 2021. I get my $1.65 of premium. I've got $1.65 accrued of profit to date. That's about 10.3% ROI so far. And I'm going to do it again and again and again. As I told you, my traders tend to go about 5 cycles before the trade ends. What if it drops? I've got that built-in profit buffer of $1.65. It can drop all the way to $16 and I'm fine. Some more gains. These are some of our symbols where we've got that leveraging. 43% on Yandex, 9% on Guess, 2% on Bloomin' Brands. Here's the last section of our call. How can we drastically reduce our return on risk? Should we sell half as much option premium? Should we sell out-in-time options? Should we collar the investment by marrying a protective option? Or is what I'm talking about not even possible? Please answer now. Only one answer applies. Sell half as much option premium, sell out-in-time options, collar the investment by marrying a protective option, or is what I'm talking about not even possible? I'll give you 3. I'll give you 2. I'll give you 1. If the answer you came up with is collar the investment by marrying a protective option, you're absolutely right. That's what we do. So you might say, and I'm just looking at your results, 89% of the folks who answered that got it right. So there's a timing involved in this. I'm going to come back to that in a second. Actually, let me show you. Do I have it on me? I'm going to show you a trade that we had done. I have a log of it. Yeah. Is this it? No, that's not it. Give me 1 second. Here it is. This is a trade that we did on Ericsson. And here's what I want you to notice about this trade. So I bought 1,100 contracts on Ericsson. And then I sold my December 9 call I wound up making 20 cents. So I paid $8.30, as you can see here. I made 20 cents, and then I bought my protective put. So that cost me 5 cents. You can watch, including commissions, what's happening over here. So $8.31, that includes the commission. Then it drops by 20 cents. Then it gains by 5 cents. My cost basis is 5 cents. What happens here? This call option expires worthless. It was 20 cents that I got up front. Then it wound up expiring worthless. Then we sold back our put. Why did we sell back our put, our protective put? We didn't need it anymore. And we sold it back at a time of peace, right? We bought it at a time of peace, and when we sold it back, we got 25 cents. So not only did I make 20 cents on the premium, but by selling back my insurance, and for those of you that are traders, you might understand this might be ringing a big bell for you. See, we're not just profiting on the premium. We're also profiting on selling back our protective insurance when we don't need it anymore. Two sources of profits. We made a total of 40 cents here instead of the usual just 20 cents if we were just selling premium. Plus, we were protected all the way down to the $8 strike price. We did it again. This time we sold our premium for 20 cents. We didn't get as good a price. We didn't get a nickel. This time when we bought our protective put, it cost 20 cents. The premium expired worthless, and when we sold back our protective put, we got 25 cents. We just kept doing that, but here's what I want you to notice. Our protective put is always set at the $8 strike price. Every month we roll it out to the $8 strike price. We buy it at times of peace. Look what happens one cycle into the trade. Our cost basis is now below $8. That means if we get bailed out of our position at $8, or if the put kicks in as a protection, as a hedge at $8, we're guaranteed a minimum return. In other words, if the trade turns against us just one cycle in, we already have, well, that's what this whole chart is about. Let's see if I can find it. There it is. This is from the Ericsson trade. So even if the trade turned against us, we would still walk away with profits. In fact, the profits, because they compound instead of just add, they increase exponentially, right? They're compounding. This trade lasted for us 7 months, and as you can see, whether you get profited by getting exercised to the top side or getting bailed out to the bottom side, which many people who are trading directionally would call a losing trade, in either case, we wound up close to doubling our money on that trade. Does that make sense? How many of the show of hands that makes sense? Instead of profiting on the directional movement of the underlying symbol, we're profiting on letting the time pass by. And that time, each time we collect a premium, each time we cash in the insurance and roll it out, it lowers our cost basis and it winds up giving us exponential returns. Very powerful. Okay, so what does that mean? This is the last question of the evening, so write down, what do we have when our cost basis, our break-even price, is less than our protective bailout price? Do we have a risk-free investment? Do we have a losing trade? Do we have too much complexity, or do we have a crack pipe dream? Some of you might be from the same generation I am, late 70s, early 80s, where you remember when everybody said you were a crack pipe head. A pipe dream. Which is it? A risk-free investment, a losing trade, too much complexity, a pipe dream. I'm going to give you 3, 2, 1. Excellent. So we have a risk-free investment. So very early on in these premium trades, we get to have a risk-free investment. So now it's time to review the 3 steps. I'm going to start by buying or shorting an underlying security, or I'm going to buy a substitute option trading at parity. Step 2, I'm going to sell a near-term at the money option for its premium value. I'm going to collect an instant dividend and a profit buffer. Step 3, I'm going to collar the whole thing with a married option that is 1 month out in expiration. That's going to protect the whole investment. I'm collaring at a time of peace, not a time of war. Let's again review this on an actual chart. So if I'm doing the covered call, or instead I'm buying a call option that's trading at parity, first after a bottom is found, I'm going to be buying that covered call, and I'm going to be putting a bailout strategy like a stop loss order in place. At the next top, I'm going to sell a near-term call option, and at the same time, I'm going to buy a 3 to 6 month out put option. The strike price of that put option is going to be at or around the bailout price. That near-term call option is going to expire worthless. And at the next bottom, I'm going to sell back that put option. Now, here's where it gets exciting, because you all know that that symbol worked well until about 3 or 4 weeks ago. So what happened 3 or 4 weeks ago? Couple of things happened with our positions. First of all, if we had only gotten this far and it took a turn on us, we got stopped out. Now here's a candidate. Every Thursday, my team and I, meaning all of the folks who are part of my program, get on a webinar and we prepare out a position. One of the positions you should put in your notes that you should be thinking about looking at, because we prepared it out in detail, is a ticker called EPC. We planned it out this afternoon and it worked very well for us. EPC. And as you can see here from our planning spreadsheet, when we plan out this trade, you can see here that our trade is planned out for 17.3% max reward or 2.3% max risk. When we actually put an actual trade in there, it turns out that we set ourselves up for 32.7% gains with a 9.4% risk. But our portfolio size, we only used 44% of our portfolio. So we wound up risking our portfolio of only 4%. So that's the worst case scenario. The worst case scenario is if you didn't get past cycle. So if you had purchased an underlying symbol, say for instance in February, and you were hoping to sell premium in March, but instead the market took a downturn, you got stopped out, and at the most you maybe suffered 3 to 4% loss to your portfolio. Now, I've been hearing from people all over that they've lost half of their trading portfolio, half of their retirement account. Any trader in our program has not suffered any more than a 4% loss to their portfolio. And that's for people who are trying to sell a call premium in February. If they were in the position, as I showed you with our example, This was not the first cycle. They maybe had bought it back in January or December. If they had been in it 2 or 3 cycles, they were already in the risk-free zone. And so even though they got stopped out, they still wound up with gains. Does that make sense? How many to show of hands that makes sense? Again, because we are focusing on the time component of the option, not the directional component. Now, what about those folks that were able to sell their premium and they were able to then also buy the protective put? Well, the protective put has kicked in. The protective put has kicked in. The underlying symbol was exercised out by the bailout strategy. We're waiting for a bottom. We buy this protective put after a top has been found because that's the ultimate time to buy that put because the position is at a time of peace. So if the underlying symbol took its crap, which many of them did, I have 2 of them in my portfolio, after you sold your premium and brought your protective put, your underlying symbol got liquidated by the bailout strategy, and now you're just in a long put. That put that I bought on Brandisco, I bought a put for 15 cents. Currently, that put is worth, let's see, I'm going to look it up. The put that I purchased for 15 cents. It's an April put. It is the $7 strike price. So the put that I bought for 15 cents is currently worth somewhere between $1.42 and $5.40. The market is acting squirrely. But if you take the halfway point between $1.42 and $5.40, you're talking about $3.40, $3.50. So something I paid 15 cents for is now worth, I could probably get $3.50. I'm going to sell it once the market bottoms. Does everybody see how that protective put has kicked in and become in the money when it was originally out of the money? And I'm simply waiting to do the same thing that I did on this particular chart, whether it's channeling or whether it has gone to the downside. As soon as it hits a bottom, I sell back that protective put. If it dips down below the strike price of the protective put, when I sell it back, it's going to give me a dollar for dollar payback for every dollar I went below its strike price, right? Because it transitioned to in the money. How many with the show of hands are following with how our hedging strategy will bail us out when we need it to, and otherwise is just a strategy that we wound up adding a second source of income to our trade? It's really quite exciting. And you'll notice here, each one of these dotted lines is between the expiration dates. You'll notice that we do about 3 transactions a month. We're not active traders by any means. We simply check in with the market every evening and see if there's tops or bottoms. If there's tops or bottoms, we plan a trade for the next day. Most of us automate those trades so that we can do something during the day. Let's take a look at the covered puts. Covered puts is almost the same exact thing, but you start when the market is at a top. Here's where we either short the underlying, that's a margin trade, or we buy a put option trading at parity, that's a cash trade. We put in our bailout is to the top side. At the bottom, we sell the near-term put option, that's our premium, and we buy a protective call. The call strike price is up here near our bailout price. It's just everything in reverse. And then Once we hit another top, we sell back that protective call. Now, what happened to these folks? Because there were quite a few of us that were in these type of trades. Well, again, if we had a chance to sell the premium, it's going to behave differently than if we were waiting for the bottom to sell the premium. If we were waiting for a bottom to sell the premium and it took a dump, well, we were either short an underlying symbol or we were long a back month deep in the money far out in time put option. Both of those are really fantastic places to be. How many with a show of hands follow? Now, even if we sold our premium, what does that mean? It means we're going to get exercised. It means that our protective call option is probably worthless at this point, but we're going to get exercised, and depending on how many cycles we've been in there reducing our cost basis, we're going to walk away at the top of that orange line with whatever max profit that position had in store for us. So all around, when you focus on trading the time component of an option instead of the directional component of an underlying symbol, and you take your time to hedge these things the way we do, there's no way to lose. The most you're going to lose is if you have one of your trades has up to a 4% hit. None of this 50% loss of your portfolio. How many with the show of hands does that make sense? You get that, right? Good. Okay. You need some symbols. First, how would you like to never miss a pick, minimize the amount of time you spend away from the folks that are important to you, have the support whenever you need it, and most importantly, how would you like to take advantage of all this stuff now that you're being forced to spend time? Many of you are being forced to spend time, shut up, away from people. Now's the perfect time to learn this process, this methodology, this trading system. Now's the perfect time to make this market profit for you while everybody else be on the other side, the side that nobody talks about. We're in a safe place here on this call. We've already acknowledged that the humanitarian crisis sucks, but be on the other side of the financial segment. Be one of the ones who is gaining the money like we are. Because that's what it's all about. It's about saving time, creating clarity, getting results. So is it okay if I take a couple of moments to tell you a little bit about the materials, the training, the tools to see if they're right for you, also give you the symbols, also give you access to the white papers. I'll also answer any sort of questions. Is that okay? Thank you. This is for someone who doesn't want to pay for all the data subscriptions that we do, wants everything they need in one place, doesn't want to miss any opportunities, wants to spend more time doing other things, doesn't want to do this alone. They want step-by-step instructions. Someone who wants to get consistent, reliable results. Okay. Where did I get these symbols, by the way? I'll show you. I'm right here, right now, tell you about, if I go to tradingtrainer.com, I'm just in a Google Chrome browser. If I go to tradingtrainer.com and I click on login, it's going to bring me to our members only portal. I'm going to use my email and I'm going to use my password. The folks who are part of this program, we have 3 different screeners. we have our main premium selling screener. And you can see it sifts through and finds out of 12,000 underlying symbols. These are ETFs, stocks, and indexes, and over 900,000 option symbols. It mixes and matches and it finds the best candidates. Here's one of our screeners. Here's another one of our screeners. We have 3 different of these screeners. They look at the market slightly different ways. This one actually found quite a few candidates. This screener is looking for sideways channelers. You can see that there hasn't been, because of the downturn, many sideways channelers. But the first 2 screeners, I'm basically giving you symbols that have been vetted out by our team this morning from our premium selling pick list. Write these symbols down, please, because we're preparing trades on it. EXTN. This is in the therapeutics healthcare market. Poised to be good. Anything in healthcare is poised to be doing well on any sort of rebound. Sprouts food market, an organic market that now is in the mail order business. We already talked about pets. Quart, C-O-R-T, another ticker that is in the healthcare market, I believe. And OCUL, EPC. I want you, these are tickers literally today when we had our premium selling workshop. In fact, here is the worksheet we did on EPC. We configured this during the webinar today and came up with a plan for covered call writing. You can see the plan right here. Go long 1,000 shares of EPC after bottom is profound. I mean, this software that we give you that runs on Excel, if you're part of our program, tells you literally exactly what to do and when to do it. That's for the covered call, covered put. In fact, on Thursdays, I'm going to go back into our Google. Where did I put it? Did I close it? No, did I? I did. Let's open it again. I apologize, folks. I wanted to keep that open. I'll log in again. Tradingtrainer.com. Thanks for your patience with me. Once we're at tradingtrainer.com, I'm going to go to login. And I'm going to log in. Now, if you don't have login because you're not part of our program, well, you should get login. You should be part of our program. Okay, I don't even know my... Maybe it's that password. There we go. Check this out. I'm going to come over here. Let me make this full screen. Our website, by the way, our portal here works on mobile devices and on tablets. So if you're one of those people who uses the web but doesn't use computers, that's fine. I'm going to come right here to our premium selling workshop replays. Check this out. What we did today is already up for a replay on EPC. And this video of the workshop, we always create replays of all of our workshops, is available for anybody to watch. We record them in 1080p. You can watch them at a faster, that's my hint, I always watch it at a faster than normal pace. But check this out. If you scroll down, you can see exactly what we did during the webinar, how we filled in the blanks. So even if you can't make the live webinar, you can fill in your spreadsheet with our numbers and be ready to go the next day. How many with a show of hands like that idea? The idea is we call it learn while you earn. We want you to be able to get started as soon as possible. So we like you to have actual positions you could open as soon as the plan sets in place. But at the same time, when we're creating those plans, we'd like you to learn how to use and plan your own position. So learn while you earn. Does that sound cool? How many with the show of hands like that idea? Cool. All right, so let me get back, finish this presentation. I know some of you are like, you're keeping me. Symbols to consider. Here's a testimonial. This is, actually, I'm looking at the clock. Let's pass this testimonial. This is somebody who wound up getting sick and she had to quit her day job. She was a teacher, one of the most, in my opinion, under appreciated jobs out there. And they made her leave. She had cancer. So they made her leave her teaching job without getting her pension and like 13 years before she could collect Social Security. And as you can read here, she thought she was going to die. And she was peaceful about it. And instead, and this is what sucks, she got better, which means she had tons of medical bills and she couldn't go back to work. So kind of like this situation now, she was stuck at home, basically disabled. She was like brought to her knees by chemo and radiation. And she took the time when she was stuck in front of the bed. She got interested in the stock market, and the rest is history thanks to AJ. Oops. I will not only make a living, I'll be able to travel. What can be better than that? The instant income calendar tool is very easy to use. All you do is read a daily table, find a stock you're interested in, follow the strategy set out for you. I use this along with other strategies to diversify my plan. I recently made 14% by just spending about 15 minutes reading about the company, following the chart, and then waiting for expiration. It was so easy. Love Charlene, by the way. Okay, once a week, weekly webinar workshops. Also, here's the other commitment. If you're part of this program, you get your questions answered by private message. So you'll notice as well on their home pages, they have this thing called trading questions, and they can put in attachments. It's kind of like filling out an email, but it bypasses my support team. It bypasses my spam filters, and it falls right into my, it's an intersession. And so what I always ask people to do when they are part of our program, especially on their first setup, is I like them to attach the plan and ask me to look it over. And I guarantee that I personally will look over your trades before you make them and give you my okay or tell you not to do them. I want to handhold you, and I'll tell you not just that you shouldn't do it, I'll tell you why and what you missed. I want to handhold you, and even if it's a paper trade, I don't care. I want to be there, so I created this system where I can help you, especially when the market is doing what it's doing right now. I also have a double your money back guarantee. So I ask people to commit to me for 6 months, learn my system in the first couple of weeks, and then trade it with me being at your side. And if at the end of the 6 months you're not in a profit, then I will not only refund your money, I will also give you twice what you paid up front. Yeah. And I've been running this program since 2007. And I stick by this guarantee. If at the end of 6 months you're not fully profiting, then I'm going to give you your money back, plus I'm going to take the same amount of money out of my pocket. So this is how you get involved with the program. You go right now to optioninvesting.org/IIC. In fact, if you have a mobile phone or a tablet, turn on the camera and point it right at the screen, and you'll notice that that QR code, pointed at the QR code, this funny looking thing in the lower left-hand corner, and it'll bring you to the web page, optioninvesting.org. Otherwise, if you're at a normal computer, just type that into your browser. In fact, I'm going to do the same thing. I'm going to open a new browser tab. I'm going to type in optioninvesting.org /IIC. That's the special for tonight. In fact, I'm going to put it into the chat box. So I'm going to come over here to the chat box and I'm going to type in https:// optioninvesting.org/IIC. Okay, so if you look at the chat box in your webinar control panel, the link is there, and you're going to come to a page that looks like this. You'll see some testimonials. You'll see about the program. The program is $497 for 6 months, which is a steal. And again, just to emphasize the double your money back guarantee, if after 6 months you haven't made money and you followed my program, then not only will I give you the $497 back, I will give you 2 times that amount. That's $994. You can pay by PayPal. You can pay with credit card. If you're ready, we can give you a special deal and you can have lifetime access to this program. It's up to you. But $497 is the deal of the night. Why? Because you deserve it. Your loved ones deserve it. aj@tradingtrainer.com. Here's my phone number. Let me tell you how you can get access to my white papers. You saw how I logged in to the web portal. I went to tradingtrainer.com. And at tradingtrainer.com, there's this login button. If you click on that login button, you'll see I'm already logged in. I'm going to log out. You can sign up for the web portal. Get yourself an account at the web portal. Now, you're not going to have access to all the stuff that I have to because you're not buying the program, but you will have access once you get yourself an account to our web portal. You'll have access to the white papers. So the white papers are behind the portal. And then if you do decide to be part of our program today, when you log into the same account, you'll see you have access to all the replays, all the premium selling tools, all of the plans that we have, and access to me. The other thing I promised you is if you're interested, and I don't want you to be wasting anybody's time, especially mine, but if you do want to have a session with me, you want to talk about some of this stuff, go to programs. Then we're back at tradingtrainer.com. And go to one-on-one coaching programs. Fill out your information, and at the bottom when it clicks submit, it will allow you to schedule, it'll let you see my calendar, and it'll allow you to actually schedule a session with me. If you want to talk with me about your trading or anything like that, this is the way to do it. This is the way for you to get a complimentary session with me personally. And it's only going to be available through the weekend. You come to this, again, coaching page. You could go to tradingtrainer.com coaching, and you can get a session with me without having to sign up for any programs. However, I think that the program is a steal. We have so many folks in our program that are so happy that they're part of this program because we've been all, like I said, in a time of craziness. People are worried about their fortunes, about their bills, about their health. Not us. I'm going to open up now, as I promised, the question and answer area. If you have a question for me, please press that orange button with the white arrow. That's going to make it available for you to see where you can type in your questions. And I will be standing by. In the meantime, the website you want to visit is option singular, investing.org/IIC. If we sign up for 6 months and then afterwards want the lifetime, will it be discounted by $497? No. That price for the lifetime that you're seeing right there on that is for, and I don't, let me be honest with you here. I have a marketing team here at Trading Trainer, and they come up with all sorts of ideas, and I'm really focused on teaching people to trade. So the marketing team is run by them and all of that good stuff, and they come up with these promotions. I have been against selling the lifetime at $19.97 add-on to the $497 since day one. The price of the lifetime program, in my mind, is $4,000. They convinced me a couple years ago to give first-time folks who are signing up for $497 a deal and say, can we give them half price if they decide to do it on day one? And I reluctantly agreed. But in my mind, the thing is worth $4,000. And if you don't take advantage of my marketing team's deal on the first day, then it's going to be $4,000. Sometimes we run specials where we drop it down to $2,500, but the regular price is $4,000. Now, I don't want anybody to sign up for lifetime if you're not ready to go right now. If this presentation, if you didn't jive with selling premium and you don't, or you didn't jive with me as a teacher, by all means, don't sign up for lifetime. Trust me, in 6 months, especially with what the market is doing now, the $4,000 price tag, I mean, let's not trip over $100 bills to pick up nickels, is what I'm saying, right? But if you did jive with my presentation, what I said made sense, you saw the premium trades that we're doing, and you think this is good and this is where you're going to sign up, you've got a reason why you want to do it for lifetime, take advantage of the deal. That's all I can say about that. Good question, though. Thank you. Of course, we want to sell premium when volatility is high, but that is also when the protective put is also very expensive. Not if you buy the protective put the way we do. And Tyler, that's a great question. Let me go back here. So here's where we're buying our protective put. So when we buy our protective put, we're buying at a time of peace. That means that we're buying our protective put. In this case, this is the put. Let's do the covered call because a lot of people can wrap their head around that better. So we're buying the protective put at a top, right? Right after the top, it says right here, buy the 3 to 6 month out put option. The strike price that we're using for the put to make it a protective put is down near the bailout price, right? And so when you think about extrinsic value and you think about an option not at the money, but out of the money, yes, it's a little bit more expensive, but we're still buying it at bargain basement prices, like for instance, 15 cents, 20 cents. Because when you're talking about extrinsic value and you get farther away from at the money, this amount, even if the IV increases, the max increase happens right at the money. When you buy these things out of the money, you go from maybe 5 cents up to 15 cents, if that makes sense. So it's the way and the timing at which we buy these things, right? Just remember that you buy these things at the reversals and that we have to buy our strike prices and our expiration dates specifically. That's a good question, though. Justin says, you talk about waiting until the underlying hits a bottom. How do you know when that happens? Okay, that's a great question. So we have here at Trading Trainer a whole automated way that we like to, or I should say semi-automated. So at the end of every trading session, we come in and we have a template of technical and pattern indicators to help us determine if a top or bottom is found. And if the top or bottom is found, we then look for validation, and we've got a list of 5 or 6 other indicators we use for validation. If it passes validation for a top or bottom being found, we then set up a conditional trade the next day to get in or out of the position. Now, this is my method, and I give everybody the strategies who are part of our program on how we identify end of day tops and bottoms, how we verify them in the conditional trades we set up on the next day. If you have experience finding tops and bottoms a different way, then what I show you, by all means, incorporate that into your trading plan. I don't care, because now we're getting into the discussion of, technical tops and bottoms, right? There's a countless number of ways, but I've settled on a way because I've been trading this strategy since 1997, and I've settled on a way that I identify tops and bottoms, and that's what I teach people. Good question. Okay, next question. You talk about waiting. Okay, that was Justin. Does the 1997 lifetime have the same money back guarantee? That's the 497. So if you're going to do lifetime, you're going to do lifetime. So I don't know what else to say about that. John says, I bought an out of the money call option that expires March 20th. The underlying stock has dropped in price and will expire. The underlying stock has dropped in price and will expire worthless. I think he means that I bought an out of the money call option. How can this be saved? Okay, I'm not sure. I bought an out of the money call option that expires March 20th. Well, okay, an out of the money call option. I bought an out of the money call option that expires tomorrow. The underlying stopped in price and will expire worthless. Okay, so John, that is not a premium trade. That's not even a directional trade, because if you bought an out of the money call option that's near term, so options have to be optimized for one variable or another. You saw here in our presentation how we optimized options to be stock replacements. We optimized options to be, this is a good question. We optimized options to be, sorry, I'm just getting cleaned up here on my screen. Just want to make sure everybody knows about optioninvesting.org. So, using near-term at-the-money options, erring to the side of out of the money, please write that down. Near-term at-the-money, erring to the side of out of the money. These options are optimized for being sold to profit on theta decay. If you use a deep in the money, far out in time option, that's like a stock replacement strategy. That's good for directional trading. If you use an option that is 1 to 2 months out and it's at the money, You've now optimized your position for selling premium on implied volatility changes. With you using an out-of-the-money near-term option and you bought it, basically what that tells me is that you're kind of just shooting in the wind. You don't have a good grasp of how to use options. You didn't really optimize the option. You used an option that should have been sold, and instead you bought it. And so now you've got like every variable working against you. You thought you were getting a good deal, but because you kind of picked the wrong option, strike price and expiration date combination, so you're asking how can this be saved? I think the answer is you let it go to all cash. In other words, you take the hits on the head, and then you learn a little bit more about options before you trade real money again, because you're selecting options and then you're doing the wrong thing with them. That option you selected would have been better off sold than bought, right? Okay. The ROIs you mentioned are based on the amount of capital. This is from Justin. The capital you use on that particular trade, not your total account. How do you double your account if you're only risking a certain amount of total capital per trade? That's great. So what you will determine, and so we have this tool that we give everybody. I'm going to bring it back up. And this tool, as you can see, has risk management built in. So when you configure it, you tell it the size of your portfolio. When we do our Thursday webinars, we like to use a $30,000 sample portfolio. However, you can fill in your amount. And then the tool also recommends, and this is all from one of my white papers on how to maximize and minimize risk and how to do risk management, which is a underappreciated component of trading methodology. It's built in, the math is built into the worksheet. And so it recommends a max allowable risk to your portfolio. You can use my recommendation or you can use a different number. I always recommend never going above 4%. With that said, it will tell you what position sizing to use, how many shares. Our portfolios, and for the people who are in our program, it tends to be that with these premium selling positions, a person is anywhere in from 3 to 7 positions, and that totally vests their whole portfolio. The importance in what we focus on is vesting the whole portfolio. You have to have your whole portfolio working for you. So if you keep, for instance, 60% of your portfolio in cash, well, you're right. Obviously, the portfolio is not going to grow if only 40% of your portfolio is making 6%. Our goal is to get 100% of your portfolio invested, and with the position sizing that gets spit out by these spreadsheets, we see that portfolios have between 3 and 7 simultaneous positions in them. So you add one at a time until your portfolio is fully vested, and then it's all about just when one of them gets either exercised, assigned, or it gets bailed out, you now have free cash and you go ahead and you invest it into the next position, right? So the idea, and this is why our system, a lot of folks like our system a lot, you basically become your own fund manager and your fund is totally invested in premium selling. Good question. Tyler says, thanks, this all makes sense, but in a time of peace, the volatility isn't high, so the premium sold may not be that high. Tyler, I've been doing this for 20 years. Even at times of peace, like for instance 4 weeks ago when the VIX was down at 12, we were still making 10 to 12, 15% per month. So you can talk to me about theoreticals, but I have trades that show that it works all the time. Okay, John says, thanks. The cost of experience, another lesson paid for and hopefully learned. Yes, make sure you're optimizing your options correctly. That means selecting call or put. That means selecting strike price. That means selecting expiration date for your intended pattern that you've identified, and make sure you're buying or shorting it, going long or going short, because some of those options, like for instance, the near term at the money options, should be sold, right? All the variables are going for you to profit on time decay. If you buy that thing, it's all working against you. Tyler says, I love the idea of winning in bite-sized pieces. Welcome, you're preaching to the choir with that one, folks. All right, it looks like that's it. Again, I'm going to give you one more pitch here, optioninvesting.org/IIC. That stands for Instant Income Calendar. You go there, you pay $497. You work with me for the next 6 months. I handhold you through your positions. I make sure that not only do we start you off on the right foot, but that you get these things under your belt. At the end of the 6 months, the idea is that you can go off on your own. A lot of people wind up staying longer or signing up for life because they like our screeners. They like to find new picks that we can find for them very easily. Optioninvesting.org. How many of you, with a show of hands, learned something this evening that maybe you did not know before? Excellent. How many, with a show of hands, picked up something this evening, new or not to you, but now you have a much better idea how to wrap your head around it? How many, with a show of hands, enjoyed yourself this evening? Excellent. How many, with a show of hands, might I see you for a welcome call tomorrow to our program? Nice. We'll be talking to you tomorrow. Optioninvesting.org. Take care, everybody. Bye.